All right, after two really good days, last Friday and again yesterday, really good moves to the upside for the markets. We had a little bit of a pause, which is not a bad thing. That's not about. I still think we're on pace to continue this rally that we had the last couple of days up to the upside. Of course, we all knew we were going to get a rally, right? You're going to get a low point, you're going to get a rally. You get a red tag, you get a green tag. That's 100% of the time. It's the only thing that you can say is 100% of the time in technical analysis. Is that you get a green tag following a red tag on that zigzag chart I always share with you. The question is, what number will be in that green tag and where will it end, right? Where will we get, where will it stop? Because remember, it stops once you get a 5% pull, another 5% pullback to the downside. So will it end short of new highs with a smaller number? We get a correction. Will it go past old highs to a really large number in that green tag? Which would be really good, right? That's kind of what we want. So I mean, we really would like to know sooner rather than later which one of those are going to be, because we can, position ourselves. I'll talk about that. I'll talk about why it's important to know the difference between pullbacks and corrections. It's not just nomenclature. It's very important to know the difference between the two as early as possible. That's why I share with you all the characteristics of each, so we know, especially during the pullback stage, which one it could be. So we're going to break that down in today's video. What's driving this action here, especially the lack of action the last couple of days. What we expect going forward the rest of the week, going into options expiration and after. And then we'll talk about our trade idea, which is in one of the sectors that is surprisingly outperforming the market. It's doing well during this recovery and it's outperforming. It's probably not a sector we want to outperform, but while it is, let's take advantage with our trade idea of the day. So let's go ahead and get started. Today is Tuesday, March the 18th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between videos, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. I also put on today's already before the market close. Come down to the bottom, click this heart. It opens up this tab. Hit that like button that pops up if and when it does here. There we go. Also click on this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching and help us get back up above 50 again and keep reaching our goal. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. Again, we had a down day today, and I believe that we're still on our way up to a 5% tag, but most likely by the end of this week. If not, well on our way by the end of this week to 5%. But as we've talked about, and most of our market scholars know, we're going to have a down day or two in the midst of that, and that's what we got today. But today was not necessarily a trend-changing down day. It was just we had a really good 2 days, and we pulled back just a smidgen there. The nice thing is we came off the lows, and that kept the momentum line from getting to an extreme low. And it kept the near-term line from falling out of the reversals, bullish territory there. So, again, you can see the momentum line usually doesn't stay down here unless it's way down here. It usually doesn't stay down at these low levels. You can see it, pretty much bounces up almost immediately every time. So I expect the momentum line will bounce back up tomorrow, and we'll be back on our way up to that 5% gain. And that near-term line will most likely stay in bullish territory and probably rebound a little bit up to the upside. The intermediate line, of course, is still in the reversal zone. It will come out of it. Right? It will get above 20, probably again by the end of the week. But again, barring something significant. I mean, if new news comes out that the market doesn't know about right now, then the market will start pricing that in. But of course, based off of everything we already know, we'll most likely just continue to bounce up higher. If you notice here, this is the if I draw Fibonacci lines from the start of the decline to the bottom, we pretty much basically just got to the 23% retracement level. The 30-day moving average right now is just barely crossed below the 62% retracement. Remember, that's probably where we're going to get up to in this area here by the time it's all said and done. And again, probably not all the way up here by expiration, because it only takes a move up to right in this area to get a 5% mark. But once you get up to that 30-day, we get that bear tag, because again, bear tag, remember, is when you get to the moving average, like this, and you either start a new intermediate run or you fail. So if I were to go back to some prior corrections. If I were to go back, say, to 2022, eventually, there we go. So 2022, we didn't quite get a bear tag because we didn't close up above the moving average, but we did get light green shading in the yellow line, and we came close to it again right there. We just had dark pink shading by the time we got the yellow line when we closed up above it. So both of those are bear tag. I mean, essentially, that's what a bear tag is. That happened on the 5% rally. If you go back to COVID, remember, it was kind of unique, kind of a weird move to the downside. But 2018 was not. This is the rally, the drop, the first drop that we had. This is our first 5% move up. It got a bear tag, and we failed, and we continued to move to the downside. 15-16 was kind of an odd correction too, because again, the bear tag, was right here, and we failed. We went down to a lower low, but this is kind of a bifurcated correction where we had two legs of it. So here was one, here was the move down, and you can count this as a bear tag if you'd like, and then finally the bear tag that started the bullish move right there. But if you go back to 2011, which is kind of more traditional of a intermediate decline, which is right there. Again, we had our bear tag. This was our first 5% rally. This did not get up to 5%, but this one did. It got a bear tag, and we failed, and ultimately went to lower lows in the 200-week moving average. So, and then of course 2010 is right here. Also got a bear tag on the first 5% rally, and we failed, and we moved to lower lows down to the but we were already below the 200-week moving average, but we dropped back below the 200-day again. So it's likely we're going to get a bear tag or something close to it once we get up to that 5% move, even if we're going into correction, right? Remember, it might be a bear tag that starts the new rally, right? That starts the new move up to the upside. There's one right there. There's one right there. So either way, it's going to be a significant pattern. It's either going to start the correction or it's going to start the new intermediate run to the upside, right? Either one. It's going to start either one of those two. It's either going to start the correction because we're going to fail, or it's going to start the new bullish run. But you can kind of see where it needs to get to. And so I think today's move hasn't halted that. If you take a look at the NASDAQ 100, it's also dark pink shading and red line. It did drop below 60 and 50 with an oversold momentum line. So that's not a good sign but again, considering we're still, we haven't dipped into the range, the gap. We haven't dipped into the gap from Monday. I still think we're okay for now, at least. Your Dow Jones Industrial Average, it stayed bullish. The near-term line stayed bullish despite the oversold momentum line. So again, a really good opportunity for this to continue higher. And then finally, your Russell 2000. Again, same thing. It barely dropped below 80. It's strongly bullish. Oversold momentum line most likely will bounce back up and continue this run to the upside. Remember, this is that bear. Remember, the Russell is in correction. So it did drop. It did get a bear tag. It failed. Now, it took multiple weeks for it to fail, but it failed and then moved to lower lows. This is what we're looking for the S&P to do. Again, very similar to remember, this is what happened at the end of 2021, and then by the time the S&P started its pullback, the Russell was in correction in 2022, right? So it's the same thing is happening then is happening now, where the Russell is kind of leading the market into, again, a correction. When I say correction, and I'll reiterate this, it does not matter what the move lower is, 5, 10, 15, 20, that doesn't matter. What matters is we get below the 200-day moving average and you stay below it for an extended period of time. That's what a correction is. Trading below the 200-day moving average for an extended period of time. A bear market then would be trading below the 200-week moving average for an extended period of time, right? Those are the definitions that we use, not a particular number, because the number depends upon the rally you had going into the peak before the drop, right? So if that rally was a huge parabolic move to the upside, you can have a big drop to the downside to get to the 200-day and still just be a pullback, right? And still just be a pullback there. So it's all dependent upon, that's why I don't like to use arbitrary numbers, because it's dependent. I mean, not every 10% decline is the same, because it depends upon the move higher that preceded it. And that's never the same, right? A 10% drop after a 100% gain is different than a 10% drop after a 20% gain to the upside. So that's why arbitrary numbers aren't the same. Plus, it's really important to know if we are indeed in a correction or not, because if this is just a pullback, then that means we're bouncing up to new highs right now. We're going to get a double digit, right? Remember, if this is a pullback, which we should treat it as one until it's not, then that means we're going to get a green tag with double digit numbers in it, right? That the next green tag will go up to new highs and we'll get double digit numbers in it. If we are not in if we're in a correction, then that means after we get a smaller number in a green tag, we're going to go back below the 200-day moving average, back below these lows, and we'll be down there for a while, for a few months. That's the difference. That's why it's important to know. I know people get caught up in it's important to know whether this is a pullback or a correction, because if this is a pullback, I want to start kind of loading up. And so I can take advantage of the next green box, which will be a big number, right? I want to start loading up now, right? If this is a correction, then I'm going to use the next green box to lighten up use this next rally to start, unloading some positions in anticipation of falling to new lows and getting down to some of these lower numbers over here, right? That's what I'll use that rally for. So a lot of people say, well, it doesn't really matter whether it's a pullback or correction. Yes, it does. It very much matters, and it very much matters that we have an idea, and that's why, again, that you follow or bookmark that 9 stages of a bear market. And I'll put it on our blog as well at some point here, so you can have it on our site, so that you can recognize the stages. And that's why, again, I think this pullback has got a lot of similarities to other stage 1 pullbacks that ultimately lead to corrections. So that's why I'm looking for a green box. It's 100% odds we'll get a green box. So I'm looking for a green box. The question is whether it'll be a 5, 6, 7% number and fail at resistance and move lower. That's the question, and I think the likelihood of that, of course, is still relatively high. Here is the weekly chart. Again, we are trading a second week below the 40-week exponential. It is a slightly lower low so far. Remember, we've got 3 more days left on the week. We don't have lower close. We don't have a lower low yet. And again, next week's candle is going to be even smaller, right? Because we're at, it'll be open up right around 57.11, and we'll be right around 5600. You can see the size of the candle has crossed up above its moving average, its 3-period moving average. That's a slight positive. Again, suggesting that we're moving towards, again, a small little bump to at the very least, a small bump to the upside. You can see that's what happened here. This is the week that we're in right now. If we're following the same pattern, this is the week that we're in right now, where we crossed up above the moving average and we got a small bump before going down to lower lows, and we did it again before we went to even lower lows. So that's kind of the idea there, and that's where we're at right now, I believe. We are that close, 2% to a. We are 2% to a death cross. So to kind of give you an idea, other times that we dropped below 2%, this is the only time right here recently that we dropped below 2% and didn't get to a death cross. So that October 2023, we closed below the moving average and bounced up and moved up higher again. If I were to go back further, you can see all the other instances we got to 2%. We went below zero there. We went below zero here. We went below zero there. Over here in the early part of 2021, we didn't. We got down. We never did close on a Heikin-Ashi basis below the 40-week. We got to 2% here and bounced back up to the upside. Again, that's a little different than now because we are below the 40-week exponential right now. Over here in 2016, we didn't. Right before the election, right, we got down below 2%. We did not close on a Heikin-Ashi basis below the 40-week. Much less multiple weeks below the 40-week, and we bounced. A little difference there too. In 2023, we did close, remember, 1 week below. And then over here, we got 2%, we got below. Over here, we had a couple of times in 2012, thanks to QE3, we avoided any kind of drops. And again, we had one close there. We had multiple closes over here in June and May of 2012. This is when we started to do or consider QE3. We implemented it back here. This is when it started, QE3 back there. And then finally, we dropped below it there, and we dropped below it here, and we were in correction mode in those times. And of course, 2007, an early part there, we avoided it because of the rate cut that we got from the FOMC, the first rate cut, but then we didn't avoid it the second time. We did break through the second time, and of course 2006 here when we ended the rate hike cycle. We tested zero. I had a little bit of a death cross there before bouncing up. So a little bit of a correction, about as minimal as a correction as you can get. More of a, again, a deep pullback there. But again, I mean, being this far up above and then dropping below, you can see there's very few times that we are this far up and then we drop below that 2% mark, and now here we are. So, of course, usually I just use the 5% mark for that, and we've crossed below that quite a bit, right? It's not very common we get above 5% and then work our way down, and that's what's happening right now. If you take a look at the 3 green arrow chart, remember we've had 3 red arrows this entire time. We still do on the S&P. We don't now on the NASDAQ, so we had 1 green arrow. We've had a green arrow on the Russell for 2 days, and we're close to a green arrow there. Again, the MACD usually is the first green arrow. The moving average usually is the last green arrow, and we're still very far away from being able to get the 3 greens there. And then finally looking at the 2-line version of this chart. Again, we got above the 8-day yesterday. We closed back below it today. The MACD, you can see, is moving up pretty high. Again, we're going to get above the 17-day moving average. We're going to work our way back up above the 200-day moving average. That's where the 38% Fibonacci retracement is right now. I think we'll get above that, but I don't think we get above these two. So that will be interesting to see if that ends up happening. Of course, if I take a look at let's look at the DMI first. This is the DMI, the ADX, of course, is still very high. We're still above 25. We dropped below 30, but we're still above 25 with the negative indicator. We came out from extreme lows on the positive indicator, but we're still way below 20. So no change there. The RSI and the CCI are off of bearish. They were off of their lows, off from extreme lows, but they're still below 40 here, below 0 here. So again, I can't draw the green box again on the CCI until the weekly CCI crosses above positive 100, and we're still below minus 150 there. And I can't draw the green box on the RSI on the daily chart until it gets not only above 50, but then confirms it with a move above 60. So we're obviously ways away from that too. If I take a look at the Ichimoku cloud, the weakness here, I mean, we're still below the green line, which is the midpoint of the 9-day range. We're way below the midpoint of the 26-day range. We're way below the cloud still. We need to be above the cloud by the time it turns pink, because that's plotted. This cloud is this crossover plotted 26 days ahead. So we need to be back up above. We need to be right here by the time we get to that pink shading. So we're good chance it will be at least in this area by the time we get close to expiration, if not a day after. We'll probably be up in this area, but again, we have a long ways to go to break what is a mature bearish trend that we haven't had since 2022. If I were to look at the Bollinger Bands and the Keltner channels, the bandwidth is extremely high. It's starting to drop, but we are still in the lower half of the range, if not closer to the lowest quartile. The momentum is not as bad. It's so extreme, but it's starting to improve. We're above the Keltner channel, so that's why I say again, the low point's probably set for now. We're going to get this green tag up into this area. We'll get up. I probably won't get into the upper quartile. We might flirt with it a little bit, right? If you look at, again, going back to some of these old corrections and their pullbacks. So here's the 2022 correction, and you can see here at the beginning we got up into the upper half of the chart, flirted with the upper quartile, but failed. If I look at 2020, of course, on the 5% bounce, we barely got out of the lowest quartile for like a day. That was such an extreme move. 2018, we flirted with the upper quartile. Again, that's typical on a correction, is a flirt with on a failed pullback bounce is a flirt with the upper quartile there. Here is 15 and 16 right in here. So again, flirting with the upper quartile on these bounces. Remember, that was kind of an odd bifurcated correction. 2011 is back to kind of more of a normal correction here. And you can see again on the bounce, we flirted with the upper quartile, got in the upper half, flirted with the upper quartile before moving lower. And then of course 2010, same thing. We flirted with the upper quartile before moving lower. So, we'll most likely flirt with this upper quartile up in here before we ultimately move lower on the S&P 500. Here is the 4-week range. Of course, a lower high and a lower low. We closed below yesterday's low. It was a pretty small range. That's why, again, I'm not too strongly bearish here on this move. And today's gap is a common gap, so it means it will get filled in sooner rather than later. Potentially by, again, most likely by tomorrow. I would expect it would be by tomorrow. The rune indicators, we haven't had a low for a few days, so the red line's dropping. The green line now will hit 0 tomorrow. So we got half the things we need for a bounce, right? We have the other half is to get the red line below 70. Now, usually, again, we don't get a new 4-week high point usually on this first 5% rally. So we'll probably stay down here. Or at least we'll probably move up a little bit, but we won't get a break up to 100 on the green line, even though we've hit 0 and this has dropped below 70. So this will probably just hang around 0 for a while as the highs just keep moving away, right? The highs just keep, just stays over here. The highs just keep dropping down. So you'll stay down here close to it on the 0 on the green line, and this will fall below 70 as we move up closer to 5%. But then we'll probably end up, getting a new 4-week low sooner rather than later after that. That's how corrections, of course, are formed, and that's what I would expect would be happening this go around. Looking at the trading range and the volume for today, you can see the volume is above average, 65 million. The range is really small. So again, remember how I said that usually the ranges are really big on these strong bullish bounces? The ranges are really, really big to the upside, and that's what pushes this higher. Well, the last 2 days, the ranges have been really small, well below average both days. So not the kind of rally that we like to see. That, remember, you kind of need escape velocity to really change the sentiment, which is very bearish right now. So you need that's why you need some big days, and this keeps going up and the volume keeps going up. Well, we're not getting that. I mean, a little bit above average volume today, but the ranges are really small. That does not, again, help me feel better about the potential for a bounce, right? At all. It doesn't help me feel better about a potential for a bounce. And of course, your VIX still above 20, even though it's below 100%, it's still above 95%, so it's still at risk aversion levels and above 20 there. And again, we're almost back above 100 on the VVIX, right? So the VVIX is still pointing to that we're really not back to levels where we feel confident about the markets going forward. We're still skittish despite the rally, and as long as there's still skittishness during the rally, then the more likely that rally won't ultimately get where we want it to get to, which is up to new highs and double-digit numbers, big double-digit numbers the last time if this is one of those 10% pullbacks, right, deep pullback, the last time we had a 10% pullback, right, we didn't get below the 200-day moving average. At least we didn't stay there. So just a pullback, but it was a big move before the pullback. That's why we dropped 10% without breaking the 200-day moving average significantly. Well, look, after that big, deep pullback, we had a 27% number. So if we're going to get a big green box after this with higher highs, it's most likely going to be a big number. And so, so that's, I'm not, it doesn't seem like the market is anticipating that right now with the type of rally we've had especially the past 2 days. All right, now let's talk about what's driving this price action today. So let's go over here to the asset class comparison chart. Again, you can see, the big reason for the lack of the decline is tomorrow's FOMC number. The lack of movement is tomorrow's FOMC. Of course, the Fed's not going to cut rates tomorrow. It's very, very low probability of a rate cut. If you take a look here at the odds, I'm sure it's I haven't looked at it lately, I'm sure it's pretty darn close to 100% odds of no cut. So give me 1 second to bring this up here. That's not going to be the important thing because the market's already priced in no cut, right? The 3-month hasn't been, remember the 3-month is what prices it in, that's what moves, and it's still in between 4.25 and 5.5, so that hasn't moved at all. So no cut, no hike. The 2 years, what tells the path, right? And the path you can see has moved down. It's up a little bit off of its lows, but it has moved down from where we were in between 4.25, 4.5. So we are pricing in a cut later, right? That's what this is saying. The question is when? When is that cut coming? That's again 100% chance of no cut tomorrow. June, right now, the odds of a cut are 66%. So those are pretty high odds. Above 60 is high probability. Obviously, getting above 80 now, you're pretty much baked in the cake there. So 66% chance of a cut. That's pretty high odds for June, and that's what people are going to be watching for tomorrow, because this is a March meeting. They're going to dictate their path, right? They're going to tell us, how many hikes or cuts they're expecting by the end of the year. So remember, we're at 4.25, 4.5%. By the end of the year, the consensus here is to be between 3.75 and 4, right? So that would be what? As of right now, that would be, 1, 2 cuts by the end of the year. So the question is whether that's going to change by tomorrow. So this is what it looks like here. So it's between 3.25 and 4. Right now we're between 4.25 and 4.5. So 1, 2. That's where the consensus is. Does that change, right? Does that get bigger down in here? Do some of these 10 disperse themselves down here? Are we looking for more cuts by the end of the year? Or are we still only really looking for like 2? Because remember, they usually do it. They usually cut at these quarterly meetings in March, June, September, December. Then they'll cut at the others if they're in the midst of a cycle. But they usually start the cycle either in March, which obviously not doing, or in June. So that's kind of the next meeting. That if we get 2 cuts starting with one in June, then it's like, okay, maybe June, maybe September, and then we're done. But if this starts to gravitate more down here, then what the Fed is saying is we might start in June and then cut for a while. Right? Remember, there are, as of right now, if they start in June, there are 1, 2, 3, 4, 5 cuts in June. And as of right now, again, going back here, this would be, this is no cuts, right? This is where we're finished 2024. This would be no cuts. This would be 1, 2, 3, 4, 5. There is one participant at the last meeting that expected 5 cuts this year. Does that start to, do we start to gravitate more? That would be a cut at every meeting starting in June, if that's the case. And of course, that would mean the 2 years dropping. That would mean the 10-year is dropping, right? The 10-year note would start dropping down here to the downside. That's what that, you'd start to expect that to drop down. And then you would also start to expect the I don't know why this is showing like that, but the 2 to 10-year spread will start to move up. It's already moving up, it's already back below, up above 0, right? And the question is, like, if we start cutting 5 times at the end of the year, it'll move up closer to 1.5 or 100 to 200 basis points, which is now, that's recession level type movement on the spreads, whether it's the 10 2-year spread or the 10-year 3-month spread. Either one of them, that's kind of what we'd be looking for here, is a jump back up here towards, in this one, back up towards 200 to 300 points. Remember, the 3-month is a proxy for the Fed funds rate. So we're talking about, the Fed funds rate dropping 200 basis points below where the 10-year year is, which right now is 4.25. But of course, this would be falling, so it would be obviously a bit lower than that. All right, so that's kind of what's driving the lack of movement. You can see gold's really been moving higher in stocks, of course, U.S. stocks in particular, really moving lower. Because look at the 3-month returns for developed markets and emerging markets. Those are really, really strong moves up to the upside. Again, if I take a look at the ratio chart of developed markets and emerging markets relative to the U.S. stock market, so let's go EFA relative to SPY. You can see since 2009, we've been below the 200-week moving average, and for the most part below the 50-week. Sometimes we get above the 50-week and make a run like we did in late 2022, early 2023, and we're doing now. You can see we are way up above. This is the weekly chart. We are way up above the 50-week moving average right now. We have gone parabolic. We've gone from extreme lows to extreme highs. We don't do that. You notice we don't do that. We don't go from extreme lows to extreme highs that fast. Look at that PPO as high as it is. Again, only other time has been over here in the last 20 years. And of course, look at the positive ADX and the CCI. We have gone parabolic. And all these other times, we didn't come off such an extreme low point. We have flipped the script here very quickly. from one direction to the other. And you kind of, like, if we're going to change, like you can see that big move there didn't change the trend. So if we're going to change the trend, you need a move like this, and we might be getting that. But you also notice that the correlation, in this case, the 63-week correlation of this ratio with the S&P is most of the time pretty negative, right? So like we don't like if this starts to outperform, it's generally because the S&P is falling. So this is not a ratio we want to improve, right? We want this ratio, to moderate and come back down. But as of right now, it's looking like developed markets and emerging markets are kind of the place to be. And you can see that over the past 3 months. And if I just look at again the last three days since the low point that we have as of right now, the 14th. You can see again, developed markets, emerging markets doing very well. Real estate stocks, IWM not doing too bad on the bounce, outperforming the Qs. But look at the dollar. The dollar is, way lower here to the downside. Way lower, 0.5% down to the downside there. So again, if I take a look at, we can take a look at the dollar index. In fact, let's take a look at it on this chart. We can see. Just a second to do that again. But look at me, it's a 5% drop on the dollar. That's a pretty good size move, relatively speaking, to what we've seen in the past. If I take a look at it relative to its moving averages, we are breaking the 200-day. The 8 and 17 have crossed the 200-day now. We are significantly lower here. And then you look at like bonds and bond yields. Well, let's take a look at bond yields. Let's do bond yields here. Bond yields, again, are hovering around the 200-day and are back down today, again, flirting with that very important level there. And then finally, commodities, the third head of that monster, it was down today pretty significantly. So, again, remember those three things: yields, the dollar, and commodities. Like when they have gone down in the past, it's been bullish for the markets. But that was in an inflationary environment, and now it appears that we are leaning more towards a deflationary environment because all three of those things are dropping along with equities, right? Which is not the norm, right? Normally, especially when the dollar drops, that's really beneficial for stocks and equities, and that has not been the case here. I mean, a little bit the case the past few days, but not in general. In fact, again, looking at the correlation here of the dollar and seasonality of the dollar with equities, you can see we are way down, and this is a seasonally weak period for the dollar going into early May, and we tend to bottom out here in early May and then retest those lows in August by the time it rallies. So if this is a period of weakness, even with a short-term little bounce, if this is generally a period of weakness for the dollar, then considering the positive correlation right now, this might be a period of weakness for the S&P as well, which again is what a correction is. That's what that correction would be. If I take a look at the breadth today, it improved so much yesterday. We lost a little bit of that improvement today. We went back down to being negative, but again, just barely negative, so that's not too bad. We never did get above positive 35, but at least we were positive yesterday. If I take a look at the things that we look at here, for instance, number of stocks above the 50-day moving average, we're not back above 200 yet. We're close. At least we bounced back up to 200, but we're not back above the moving average. It's almost below 200 itself. The number of stocks above the 200-day moving average, it needs to get back above 250. And we've bounced, but we're not back above 250, nor are we back above the average. In fact, the average now is almost below 250. So the breadth is not looking it's not looking like it's improving significantly here. We did get some new highs. Let's see what today's. Let's make sure it's updated yet. For today here at 47 is today's new highs. So yeah, so the new highs is really down, but we're not really breaking out up above the new highs, and the new lows that we kind of watch for to be above that 4% mark has dropped dramatically below that 4% mark, and needs to kind of stay down here if we're going to really rebound up to the upside, because the average itself is really close to being above. And if I take a look at the net new highs and lows on the New York Stock Exchange as well as the NASDAQ Composite, we are now above the minus 100 level, but we're not above zero, right? We're not above zero. We're above the average, but the average itself is pretty darn low. Again, is at correction level lows. You can see it doesn't usually get, it got down here in October when things got pretty bad in 2023. But in general, you can see when it gets here below, like to these current levels, like it did in 2022, we went into correction. Like it did in 2020, like it did in 2018, like it did in 2015. Like getting down below 250 on the net new lows is generally a level, and it's generally like that's a level for. In fact, it didn't get below minus 250 there. 2003, of course, it did. And remember, 2003 was a correction inside of the pullback range. Like it had characteristics of a correction, but it never dropped below the 200-day moving average because we were so bullish going into that peak before that. But still, like, you know, here we are again. We are slightly below the 200-day moving average, and the net new lows, new highs and new lows suggests that this is more than just our garden variety pullback like we've seen in the past. Let's take a look at the sector moves, and that's really the important thing. The sector moves continues to not be where we want it to be, right? We need XLK, XLY, XLC to move up here to the leading. They're not really moving in that direction. We still have all these other sectors that are still, you know, negatively correlated with the markets when they're outperforming. Safety trades, energy, especially like that energy sector, that is not a sector that we want to see doing so well, and it's, you know, it's strong. It's well above its 50-day moving average on the ratio chart. It's in the leading category. That's not bullish for the markets, right? We need XLK to be above its the ratio to be above the 50-day average and in the leading category, and it's not. In fact, the momentum that we've had appears to be waning, even as we are still well below the 17-day moving average, and for that matter, well below the 17-week moving average, clearly below the 17-week, which, again, unless we rebound back up above it, usually means that we're going to be below it here for a while. And this, you know, we've been below it over here for so long that we're finally now, you know, again, with both lines below 100 in the lagging category, and that's not bullish, right? They need to both be rising and getting above 100 for us to, and this to be above its ratio. The ratio to be above its average for us to be bullish, and that's obviously not the case right now. Here is the sector rotation on the 3-day chart, so we'll come back here to the comparison, and again we'll do the just for the 3 days, so that we've come off the low point so far. And again, energy, financials, I mean, these are not the sectors we want to be leading the move up here to the upside, with communication services and discretionary lagging the market and lagging pretty much everything except for staples. Until like the afternoon today, it was even, you know, they were lagging literally everything until staples had a late drop at the end of the day today. All right, well, that brings us to our trade idea of the day that happens to be in the material sector here, and it is on X. So if I take a look at U.S. Steel, U.S. Steel looks really good. We're breaking out. We're getting up to new highs. We have dark green shading a green line. Intermediate line crossed up above the market sentiment line, crossing the bullish territory. We are close to the 90th percentile, up above the 30-day moving average there. If I take a look at its weekly chart, you'll see that you know, we have a good bullish candle. We have a golden cross. The nice strong candle here. The PPO is rising up above 0 now. Obviously, we have 3 green arrows. In fact, on the second day of the 3 green arrows here, we had some pretty good volume yesterday, so that's positive. You can see, if I take a look at the 2-line version of this chart, we crossed up above the point of control in the last few days. The 8 and 17 day are moving above the 30 now. You know, again, we're close to that golden cross where the 50 crosses above the 200. We're above the point of control. We're breaking out of the value area, strong positive MACD and stochastic indicators. All the other oscillators are looking pretty positive as well, above 30, below 20 on the directional indexes. ADX starting to rise. The RSI and the CCI, you can see above 60 on the RSI, above positive 100 on the daily CCI. If I look at the weekly CCI, we're also crossing above positive 100 for the first time. So that's a very positive development. If I take a look at the Ichimoku cloud, we're above the cloud. The cloud has turned green. We got above the cloud by the time it turned green. We have a weak bullish trend formed here, And then finally, looking at the Bollinger Bands and the Keltner channels, we have crossed outside of both the upper band and the upper Keltner channel with positive momentum. The bands themselves are probably a day away from crossing outside the Keltner channels themselves. The Bollinger Bandwidth is rising. So I like this setup here. So what I decided to do is to do a long call trade. So buying the at the money option, the 42 in this case, with a 50% stop order. Again, that's right around, let's see here, let's get rid of, there we go. So we have $800 maximum loss, so $400 with a 50% stop. And then if it does make the one standard deviation move by end of May expiration, you're looking at about a $1,600. So over 4-to-1 reward to risk ratio if it plays out. So I like that setup there. So there's our trade for today. All right, and that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter, and Facebook as well. Have a great rest of your Tuesday night, everybody. We'll see you all tomorrow.